I'll hit record now. So I've hit record. So hi, Paul. Everyone, Paul and I have a conversation most weeks over the phone, and we thought what we would start doing is recording it and share the video and the content with yourselves, which I hope you find useful. Okay, so Paul, over to you. What questions do you have me for this week?
I thought we should talk about the stock market and the economy, the wider economy. It's very big in the news. So this morning we arise to news of a correction. Can you explain what a correction is in the stock market?
Yeah, a correction is a significant pullback in the market prices. So if you look at the overall investment market, you have stock exchanges. Stock exchanges tend to be things like the London Stock Exchange or the alternative investment market, the AIM market. And in the US, you have things like the NASDAQ, which generally is a technology exchange, and you have the New York Stock Exchange. There's many of them around the world. But to measure the success of these stock markets on how well they do, they are put in leagues or indices. So in the UK, the most common one you'll be familiar with will be the FTSE 100. And the one that everyone's speaking about in the US is the Dow Jones Industrial Average 30. And when these indices, these leagues, pull back from their previous price, and they pull back a certain percentage, the pundits, the journalists, call this a stock market correction.
Okay, and is there it seems to be around a 10% correction, as they're calling it. That seems to be the term.
Yeah. They do. And what reason I'm avoiding sort of saying things like this is I try to sort of keep away from the specifics around it, because I think when you start doing that and you put labels on it, you then start getting emotionally tied to it. You start getting concerned about it. And really, it's more about looking back and saying what's happening and why is it happening, and what's the greater economic environment impacts.
Yeah. So why is it happening? What's happened? Because the stock market's been rising for a long time now, and record highs and all of that.
So if we cast ourselves back about 10, 11 years, 2007, we had the financial crisis. Getting us out of the financial crisis was the financial stimulus package, which was quantitative easing. And most of us at the time, and myself included, thought, what on earth is quantitative easing? Now we all understand quantitative easing is basically the reproduction of money and using that money to buy back government debt. What that does, it puts a lot of money in the economy. And very slowly, the economy's been recovering. And then we have a general election in the US, and we have a new president. And this new president is a bit of a maverick. And what he's done is he's slashed up lots of banking legislation. And in addition to that, he's done a lot of tax reform. So he slashed the US corporation tax rate from 32% to 20%. This has made it so attractive in the US that people are companies are repatriating tens of billions of dollars. So we're seeing the likes of Apple bring back tens of billions of dollars back into the economy. That is a positive sign, and it's putting confidence in the economy. So the economy is growing in the US. The US is 51% roughly of the world economy. Therefore, it's having an impact in the world economy. That's the gas on the pedal. That's you putting the accelerator down, going faster. Then you've got the police, which is the Federal Reserve, saying, whoa, slow down. And their brake is interest rates. Their job is to say, well, okay, we like the economy growing, but if you go too fast, I get nervous. It's like being on a roller coaster. I don't mind going too slow or too fast, but when it starts going too fast and I go downhill or I start going upside down, I don't like it. And the Fed doesn't like either. And then what they do is they put the brake on and they put the threat or the intention of rising interest rates. So the stock market likes certainty. What it doesn't know is uncertainty. And when it doesn't know things, it gets nervous. And that's what's happening right now. The Fed and the Bank of England yesterday said we're going to have to start increasing interest rates. But that's not a bad thing. It's not a bad thing, because if you're a saver, you want to have higher interest rates. But if you want a strong, stable economy, you need good interest rates. We need interest rates higher than they are now, because if the economy slows, or should I say when the economy slows, we need another economic stimulus other than quantitative easing. We don't just want to pump more money into the economy. And if interest rates are at a high level, let's say around about 3%, it will enable the Bank of England or the Federal Reserve to reduce interest rates, which in turn will stimulate the economy.
Okay. All right. So how does this relate to us, to people? Now, if you're an investor and a shareholder, then understandably you're going to be nervous when markets start going down. But this doesn't just affect investors, does it?
Okay, so it's all about time. It's all about time frame. So let's look at investors to start off with, then we'll look at people who are not necessarily investors, and we'll look at maybe savers, and we'll look at property owners.
Yeah.
So time frame. It's all about time frame. If you're an investor, it's all about time frame. The thing we need to bear in mind is if you need access to your money within the next 5 to 7 years, you should not be heavily invested in the stock market. Okay? Because we have experienced pullbacks like this many times in the past, and we're going to receive them or experience them many times in the future. This is all part of natural investing. Okay? What we need to do is have a look at our time frame. So if you've got more than 7 years, hey, use this as a buying opportunity. Use this to steadily rebalance your portfolio. So you're buying more equities. You use it steadily to invest more money back in the stock market. And I use the word steadily because we don't know where the bottom is. Slight pullback here, where things might stable out and they might carry on, or we might see further corrections, in which case you wish you bought in lower.
Okay.
You have an investment plan, which generally is pound cost averaging, investing in the stock market monthly over a period of time. Stick to your plan. Don't deviate. There's no need to. Fundamentally, economically, nothing has changed other than the economy is growing. We have a fear of rising interest rates. That's what's spooking the stock market.
Okay.
Now you've got savers. Okay, so you've got people who are putting money into the savings accounts wanting a rising interest rates. I think you will eventually see the effect of increasing in interest rates. But remember, they haven't really increased yet. It's just the threat of rising interest rates that's spooking the stock market. So if you're looking to save some money and you're looking to tie it up for some period of time, you're probably better off using shorter term saving rates rather than longer term, because we are most likely going to see interest rates rise, and it wouldn't be unreasonable to see the interest rates rise to towards the 3% mark, which is generally the average rate. So we're at 0.5% now. We can see over time, and it's going to take some period of time for interest rates to start rising, and it would seem reasonable for them to rise towards the late 2s, 3%.
Okay.
So savers, save money, but try not to tie up for too long, because you might see rates rise over that period of time. Okay. Then you've got property owners. You've got property owners who are either looking at capital appreciation or concerned about mortgage rates. And if you're looking at capital appreciation, really what you're looking at with a property is a fixed interest investment. In other words, you have an asset that yields you a fixed income, although be it that rise in inflation, typically it's a fixed income. Now, what generally happens with interest rates rising against fixed income investments is the capital goes down. What you might see is a plateau of property prices, or you might eventually see a slight decline in property prices. Now, we've already experienced this in London. So London, some areas of London are down 25, 30% from their highs, but they were overly inflated. And what you might see is a slight plateau in property prices coming forward because of the forecast of interest rate rising. Don't necessarily be fearful of this. If it's your main home and you live in it, who cares what it's worth? If it comes down, you'll pay less inheritance tax. But what you do need to be aware of is if you're leveraging a property, you're buying a property at a very high loan to value, don't overexpose yourself.
Okay.
And then you've got interest rate rises with owners, and you've got to make sure that when you buy somewhere or if you have a home, that you're making sure that you can afford the payments, not only on the rates that they are today, but what the rates might be in the future. So you've got a bit of buffer there. And if it enables you to switch your rate from a variable rate interest to a fixed rate, it might be something worth considering. Although you've got to bear in mind, these interest rate rises have been expected now for a number of years. You can't tick along at 1/4 and 0.5% forever. It's not a healthy economy. So these interest rate rises are actually healthy for our economy. But so when you look at your bank base rates and your mortgage rates, they're most likely to have factored some of these in already. So don't expect fantastic deals. But if you are concerned with rises of interest rates, certainly speak to your lender and see what fixed rates are available.
Okay. And then finally, what about people who don't fall into any of those categories? So those of us who aren't property owners, we're not investors in the stock market. Does this correction and what the market's doing, does that affect us as well?
Well, the correction in the stock market is basically a pullback from its natural high. Okay, so I don't think in isolation the stock market correction affects people, particularly if you're not investing. And if you're not investing, ask yourself the question, why aren't you investing? You really should be. In previous videos, I talk about this 12.5%. So you really must make sure that there's at least 12.5% of your total income left over every month. And you first use that to pay down your unsecured debt. And then once your unsecured debt's gone, you use that money and split it between mortgage overpayment and investing. So if you're not investing, probably see some previous videos that I've done on the 12.5%, which I call the snowball. But if you're not a property owner, then interest rates don't concern you. But what we might start seeing is wage price inflation. So there's been lots of talk about wage stagnation over the past number of years. And that's really because inflation's been so low. Inflation really hasn't been picking up. Inflation is about to pick up. So that's why interest rates are picking up. And therefore, when you see interest rates and inflation pick up, you should naturally expect prices to pick up and therefore wages to pick up. So these are natural, healthy things within an economy. We're going back to more the mean, the average, and what we would expect. But unfortunately, the media dramify things and scare people with a lot of it by saying there's a stock market crash. If you're not an investor, maybe consider becoming an investor now, because it's a great time to get in the market with volatility, but only if you've got 5 to 7 years to invest. If you're looking at the next 3 to 4 years, if you're looking at maybe a house purchase or something, and you're saving a deposit, it's not the place to be. Okay? So sorry about that, it's my phone. So you really need to just make sure that you're putting money away into the stock market if you're investing for 5 to 7 years only.
Okay, and now you'd say is a good time because it's dipped slightly, and as you say, where does the balance come? Because you want to get in as low as possible, of course, but you don't know how much more it's going to fall.
You'll never get in at the bottom. Okay, if you do, you won't do it again or a second time because it'll be purely low. All right. But really what you need to be doing is looking at your compelling vision. So we have a 5-step process with a money plan. First, step 1 is your compelling vision. What's your outcome? What is it you want to achieve? Okay. Go back to your compelling vision. If you don't know what that I'm talking about, look at one of our previous videos. It'll explain it. But really, the best time to start investing was yesterday. Second best time is today. So step 1, know what it is you want. Step 2, let's get organized. Step 3, let's make sure your house is in order. Look at all your foundations. And step 4, pay down your unsecured debt. Then step 5, invest. So step 5 is the last step. Before you get to there, you've got all these other things you need to do. And it's really important that you do those things so that you can start investing. You really do need to invest. And what's actually ironic is if you're listening to this or watching this and you're an employee, the probability is you're also enrolled into your workplace pension. So you will be already invested, but you're probably just not engaged in that. So what you can do is start educating yourself and get more engaged. So learn a bit more about pensions, how they work. I've just done a blog post on my website today telling you the different types between a personal pension and a defined contribution, and a defined benefit pension. So you've got a bit of comparison there. But speak to your employer, get some information on the scheme, find out where your money's invested. Really, you should be invested internationally, globally, not just in the UK. We're in a global world now. You're probably watching this on either YouTube or Facebook. These are US companies. When you order things, you typically buy things from Amazon. It's a US company. We need to invest globally because it's a global economy.
Okay. Yeah, I think that gives us a good overview.
How are you feeling about the stock market correction now?
Well, from the sounds of it, I wish I had more money to invest.
Okay, that's fine. But are you concerned with it? Do you feel it's like a global meltdown?
No, but I've got some experience of working in the media, so I understand the kind of sensationalism a little bit that comes along with these things. I guess it's all tied in because there's two, for me at my age, there's still two very recent examples or very well-known examples, the dot-com and the crash in 2007-8, where financial and the market were a big part of that and did cause widespread pain and heartache for an awful lot of people. It affected everybody, not just the people that were in the market.
And I completely agree with you. And this is when the table of success shifts from the baby boomers who have had all the gold-plated final salary pension schemes and low property prices to the millennials and the youngsters. So if we do experience a 50% correction, that's the kind of correction we experienced in 2000 and again in 2007. What a great buying opportunity. What an opportunity for you to invest in the stock market and buy some of your gold-plated brands, your companies that you love, or buy a global index fund. Buy at the low or near the low, because you'll never hit the low, and just hold on to it until you need to retire. If you've got 10 plus years to retirement, this is a perfect opportunity for you to get involved with this. It's like going to your favorite store and saying that things are on a 10% discount right now. But if you wait, they might go lower. Okay. Been helpful?
Yep, been very helpful. Thank you.
Great. Take care.
Cheers,
everyone else who's listening, just remember that I'm speaking live on February the 27th at the Yes Group Bristol. So if you can make it along in the evening, that'd be great. There's information on my website, and I look forward to seeing you. Take care.
Yes.